Welcome to Chit Chat Stocks, a podcast that helps you discover your next great investment. I'm your host, Ryan Henderson, and I am joined as always by my co host, Brett Schaefer. Today, we've got our weekly Power Hour episode where we talk all things financial markets. It is the heart of earnings season. Today, big tech is reporting, or at least most of the big tech companies. So, this is when we have the most news, plenty to talk about, and we have plenty of topics for this week. Of course, there are more OpenAI partnerships. There is earnings. We've got Netflix, Visa, SoFi, PayPal, and plenty of others. And I've got a little fun topic for the listeners as well. I dug into some of the most critical suppliers to the data center space, the picks and shovels providers to the data center build out. So I'll go through some of those as well. But before we get into it, first off, please, if you enjoy these episodes, give us a review. It always helps. And we also have a newsletter, which is totally free. So go ahead, check that out. We put plenty of good charts and information up there. But without further ado, Brett, how has earnings season treated you so far?
Not bad. Haven't had much reporting. I want to ask you, how does it feel to be back? 2 weeks off, doing a live show again, talking earnings. Was there anything you were itching to talk about that you couldn't last week? Netflix earnings, a little. Of course, people in our newsletter chat were making fun of the fact that OpenAI seems to be announcing stuff just in your face every week, so we have to talk about it. We will be talking about the Microsoft OpenAI deal. I'm assuming it's not that, but is there anything you want to talk about the most?
I did a decent amount of work on this data center suppliers, but maybe we can save that for later on in the episode. Netflix earnings, fascinating. Visa earnings, frankly, boring and predictable, but still, what a business. And then SoFi,
Macro indicator. Always my
sure.
favorite consumer macro indicator.
Yeah. There's a lot to talk about, especially in the payment space. We've seen a lot of payments companies report so far. So PayPal reported yesterday, SoFi reported. SoFi's quarter looked pretty good. And Pfizer reported this morning. The stock is down 43% before the market open.
I haven't
Yes.
even checked what the markets are doing. What happened? Yeah, we actually had a little message in the group chat. Yeah, the stock's down so much. Someone wanted us to talk about it. What happened? What's the deal?
So from what I can tell, I haven't gone through the entire conference call, but Pfizer, there's been this is one of those where it seems like the street was ahead of everyone else because, and you see this all the time where there's a slight decline in some of the fundamentals. There's cautious management guidance, and all of a sudden the stock is hitting like 5-year lows. The valuation looks super cheap on a trailing basis, and you see people thinking, "Oh, value play, value play, value play," but really the street probably knew something most investors did not, and this quarter showed that. So Pfizer reported its slowest organic growth in 5 years. They cut their full year guidance, and then they launched a strategic overhaul with a new CFO, new co-presidents, and 3 new board members.
Uh-oh, the strategic overhaul. You got That's when you know
Yeah.
things are going bad. That's like when the manager gets relieved duty on the sports team.
Yes.
I'm not gonna be doing the offense anymore. Someone else can call the formations.
Yeah, apparently this is supposed to be a total company reset. So here's one quote from the conference call that I saw. Pfizer's recent results have increasingly relied on short term initiatives. These initiatives place too much emphasis on pursuing in quarter results as opposed to building long term relationships by prioritizing business that both meet our clients' needs and comes with high recurring revenue. As a result, we have made the decision to deprioritize these short term revenue and expense initiatives, which of course has some near term impact on our growth and profitability. For those unfamiliar, Fiserv is sort of a hodgepodge of payments processing businesses. They've been an acquirer over the years. And I think we've kind of seen, especially lately, a divergence between the stitched together payments processors and the built from the ground up payments processors like Adyen and Stripe. We've seen sort of a divergence in results, and I think you're seeing it from the customer perspective. It can be cleaner to just go with a one-stop shop solution like a Stripe or Adyen as opposed to some of these other stitched together businesses. But I don't know the business super well, so I might be uh, that might kind of be
Neither do I.
over
I
my
get
head.
confused on this one, and
But
it bores me to sleep. Honestly, I'm glad I'm not interested because it's down at 40%. That's for a company like this. This sounds. I would not believe you if you said this was possible. Now, an Adyen, sure, but Pfizer, I thought they were supposed to be steady Eddie.
yeah, they have had, I think, like decades of double digit earnings per share growth. So this is like a major turning point, and this is their largest drawdown in 35 years. They are down 70% from all-time highs. I I saw a lot of people talking about the buyback yield. They have been a big repurchaser, which that's when like I love buybacks, but when the buyback yield is above 10%, there's typically a reason. So I found that like the best share cannibals where you get like better than expected earnings per share growth because they're buying back tends to be a lower current buyback yield, but it's steady and progressing. So anyway, that's kind of a side tangent. But after their 70% drawdown, Pfizer stands at a $68 billion market cap, roughly. They do $6 billion in annual operating income. So price to operating income is around 10 times. That if this is a major reset,
Yeah,
that is
how's
not
the balance
cheap.
sheet?
Uh,
How's the balance sheet?
I'm pretty sure it's like 20 or $30 billion in net debt because the enterprise value is almost above 90.
Okay, not terrible. As what's the meme? Not great, not terrible.
Yeah.
The Chernobyl meme. Yeah. Well, it could be a buy. I just what excites me about this company now? Nothing. Sorry. If people can make money on this, I'd like to make money on companies that actually interest me. And if that means there's an opportunity to buy this boring business, so be it. Someone else can do it. But I have, I have absolutely zero interest in any of these type of businesses. Not necessarily like the Adyen of the world, but these legacy payment processors and all the good stuff. All right, let's
And
talk about
it's
one that the listeners, unless do you have something to add there?
I just want to add that like unless you are a constellation software where you buy these businesses and you just let them operate independently, I tend to be wary of the like opportunistic acquirers where it's not like a stated part of your strategy. You don't have this blueprint to like buy and then integrate and like it's just like you kind of buy businesses to fix holes in your current like product suite. That I don't like because it's the quickest way to enter a market, but it always leads to problems down the road. And I think you're seeing that now. Adyen chose to build from the ground up, build their solutions from the ground up. I think at any point they could have gone out and acquired companies to basically bolster their product offering. And instead they said, no, I want to build these solutions on our own because it's easier to diagnose issues later on. It's easier to, you own the infrastructure. You're not like, it wasn't built 20 years ago by developers that are no longer with the company. And anyway, I be cautious with these opportunistic acquirers, I would say.
All right, Ryan. Talk of Pfizer is putting me right back to sleep. Let's talk about a company that people are very interested in. I wouldn't say I have egg on my face because I was never bearish on them, but unfortunately never got bullish at the right time. Maybe it's still now, and that is SoFi. It's one that you put some good notes together on. We have some comments in the chat here. I'd say for we're recording this Wednesday morning this week. Thank you for everyone that's joining. We have a new comment that says, I think a new listener, favorite book on the shelf behind you both. I see the rule breaker investing there. Yes, And for anyone that hasn't listened, I think our number one listened to episode of all time now is the David Gardner interview. Go listen to that. I thought we asked him some fantastic questions. I'll answer that one and say an underrated book behind me is The Toyota Way, a kind of history on how Toyota became dominant in manufacturing and how everyone essentially learned from them. Ryan, do you have an underrated investing or business book behind you?
I honestly wasn't sure what all was behind me.
They're
Uh,
just for looks for the show. Those are the ones that just have good color schemes.
I'd say probably the most evergreen and the one that actually applies to me the most is the Rule Breaker Investing from David Gardner, but also our friend Alex Morris, Buffett and Munger
Yeah, that's a good one.
Unscripted is back there. And that obviously has plenty of timeless quotes and advice from two of the greatest investors of all time. So I'd add that one as well. But let's jump to SoFi earnings. Look, yeah, I missed the boat on this one. Maybe the opportunity is still in front of us, but I'm disappointed because this was obviously it's competitive. Online banking is now more competitive, I think, than it's ever been. But they have just nailed it in terms of attracting customers and being sort of an attractive brand to younger people trying to build wealth. Members, they had 1.2 million members at the end of 2019. 1.2. 5 years later, they have 12.6 million members. So it's been staggering growth. And this quarter, they added more members than any other quarter in their history. They added almost a million members this quarter alone. Over the last 12 months, they have added 3.2 million members. For context, Ally Financial has like 3.4 million total retail depositors. Now, a retail depositor that's worth more. Members does not have an exact correlation to like deposit growth,
Well,
but
Ally has 5x the deposits, but SoFi is catching fairly quickly and should catch them within 10 years if Ally doesn't grow like they are today.
yeah, so SoFi got its banking license late 2022, I believe, and within 3 years, they've gone from zero deposits to 33 billion, which is pretty impressive growth. And loan origination volume, I guess here's maybe the part that I don't know if I worry about, but they're getting this flood of capital from depositors. They're getting this flood of money. And the biggest category of loans that they're offering is personal loans, which in a world where I don't know, there's a recession or something like that, I think there's probably higher variability in the delinquency rates in that sort of just overall lending category. But loan origination volume grew 57% year over year. Most of that growth is coming from personal loan growth. The delinquency rates stayed pretty consistent compared to last quarter. So the results look good. Obviously, there's some risk anytime you quickly grow a lending business because things look good until they don't. But I think the results across the board were really impressive here. There was Anthony Noto's CEO went on to CNBC and after the earnings, and they asked him about PayPal and OpenAI's partnership. I don't know if you saw this, but two of the most press release happy companies of all time, OpenAI and PayPal, announced a combined press release
Still waiting for
partnership.
that Mercado Libre partnership to gel with PayPal. Well, eventually it'll bear fruit.
Anyway, they asked him about it, and he said, "We're launching products, not press releases." I love that quote because one, PayPal is just a press release machine. They love partnerships and press releases, and it seems like SoFi is showing real growth, real traction with customers, deposits, and on the lending side. So things look really good right now. If I'm a SoFi shareholder, I would be happy with where they're at right now.
Can you predict? I'm gonna load it up right here at our friends at Fiscal AI. Use our link, get 15% off any paid plan. And I bet, well, not to tease it, but I'm almost 100% certain they will be doing a Black Friday sale. So within the next month, slash, Cyber Monday, whatever you call it, get ready. There's going to be a nice discount for you out there, and we recommend using our link to get that extended discount. All right, what do you think their forward PE is, and what do you think their current price to book value is?
I think price to book is like 4 times.
Close. Five.
5.
Five.
Okay. PE, I don't know because I don't know how much they're earning or where they're at in terms.
72.
Yeah.
72. I feel like they're probably under earning a bit since they're reinvesting. If you
And
normalize it to what they could probably earn, I guess we're pretty close to fair value now. That might sound egregious for someone that is a value investor, but I'm just saying, like, if the PE can get a little bit lower, I'm actually seeing a different reference here that someone says 57, but again, it's forward estimates, so it depends on what estimates you're using. The stock's at 31. In 2022 and 2023, you could get it for 5. So that was where the great opportunity was. Today, would I still be holding? Of course. I mean, seems like a fantastic growing business, but is it a buy today? Probably not. Now,
yeah, it's
all right.
so
Sorry. Do you
I
have
don't
anything
know.
else on that?
It's such a it kind of sits on both sides of the fence for me because on in terms of consumer applications, you want exactly what you're seeing with SoFi. Massive membership growth. There's even somewhat of a flywheel effect. More people using SoFi, they tell other people. They're launching all these products, they're offering cards, they're kind of generating revenue in a lot of different ways. But on the lending side, when I'm looking at a bank, I get really uncomfortable with rapid lending origination growth because I don't know what the net interest margin or the delinquency rates are going to be like 5 years from now. And it depends what kind of categories they're in, but especially personal loans, it, I'm both really optimistic about the consumer side and shaky on the banking side.
Yeah, you can never get 100% confident. I mean, it's a new bank, fast growing bank, stuff like that. It's not new bank, which is its own company. And we do have a great interview coming up with Dave Ahern covering new holdings, as well as people are asking in the newsletter chat to discuss Argentina and CAP Airports, Corporación America Airports. We will have an interview with Ian Bezek coming up in November to discuss all that, Latin America, get the update and all of everything that's happening there. I'll go to maybe one of my topics since Ryan has had two to start. We didn't get a chance to discuss Netflix earnings last week with Travis, where we had, I think, a lot of good topics, and we covered a lot of stuff within his portfolio, which I thought was fascinating. Very, very interesting opportunities out there. But I wanted to discuss Netflix this week, even though they reported last week. I'll go through some of the numbers. 17% year over year revenue growth. This was the highest level of percent revenue growth since June 2021. The advertising tier is scaling, and Netflix is gaining share of TV time spent. Here's a quote from, I think it's the investing letter. We've come a long way in building our advertising business in less than 3 years. In that time, we've gone from 0 members on our ads plan to achieving sufficient scale in all 12 of our ads markets. And we will continue to grow from here, building out our ad sales and operations team and enhancing our capabilities for advertisers, including launching our own first party ad tech stack. They are on track to double ad revenue in 2025. Stock now trades at, maybe I should update this because I put that in a week ago. I said a week ago it was trading at an EV to EBIT of 38. We're at an EV to EBITDA of 37 now, so it's probably about the same. The question I have, and maybe you can agree or disagree on this take, and this is in context of the, so within overall consumption of TV media, Netflix is gaining share because that's a lot of the linear is still declining. I think that's still 40% or maybe even half of consumption in the United States and higher in other areas, lower in other regions around the world. But if you look within streaming, YouTube is taking share of time spent. There's some great charts about this, and Netflix is seeing declining share of time spent within streaming video. And my take on this is that all of these services from the tech players are going to have to not necessarily combine, but become more like each other. Where Netflix, we're seeing this with the podcast licensing they're doing to put kind of talk shows on their service. Netflix is going to be trying to become more like YouTube, who's going to try to become more like Spotify, who is going to be try to become more like YouTube, who is trying to become more like Netflix. I know that is a kind of a tongue twister, but do you get what I'm saying here, Ryan? And do you agree or disagree on Netflix's path going forward?
I think I agree. The only one that maybe I need you to describe is how do you think YouTube is trying to become more like Spotify?
Podcasts or talk shows are their biggest growth driver.
Yeah, I just don't. I don't know if it's. To me, it doesn't feel like that's a targeted initiative from YouTube as much as people migrating to that platform.
100% is.
They're not pouring money into exclusive licenses with podcasters or
Oh
anything.
no, but
People just go there directly.
that's not their business model, but they are catering and building tons of tools, and I'm sure investing millions, hundreds of millions of dollars in the back end stuff for that. And we have a comment here mentions YouTube Music, YouTube Premium, YouTube Music has the podcast connections. What too? I mean, you've seen
Yeah, they've
all
been doing
their
that for 10
executives talk
years.
about podcasts at pretty much every event or every speech or every talk they give. It seems to be their number one thing, along with sports and stuff on the TV.
Yeah, I see it a lot more the other way. I see it a lot more where every podcast event talks about how everyone needs to be on YouTube. Every People are just going there because YouTube has the audience. It doesn't seem like YouTube's going to receive no matter which way media heads, people will head to YouTube. I think that's just they've got the audience. But either way, I mean, with regards to Netflix, is it cheap? Uh, I could see how it works out from here, but to me, it's a bigger business. Like it's already reached global scale. So the majority of revenue growth, or sorry, earnings growth is going to have to come from lower content costs as a percentage of revenue and price increases, mixed price mix increases or higher ad load. But I'd be surprised if subscriber growth was too too high moving forward. I can't. They don't report it
I guess
anymore,
they don't
but
share anymore. Yeah, the bane of Fiscal.ai
yes.
for not giving you that chart anymore to post on the Fiscal.ai Twitter account. So, so you look at the growth drivers, they need to get, I think, a little bit uncomfortable where, okay, one, the advertising, they hit the mark on that. And it's doing well, and you could probably see that consistently scale over the next decade and probably grow faster than their underlying legacy business. And then you look at sports, which is a bit tough. They're doing some live events, some one-off events, but they're definitely going into that because they see that that's a huge part of the market and they have to go after it, even though historically the return on spend is much tougher than other areas. And then you have things like gaming, and then you have things like live talk shows and all these other things that are maybe not within Netflix's core wheelhouse that they're trying to add on to convince people to stay, get churn rates down, and increase that pricing power. Yeah, I wouldn't buy here. It's not my favorite. I think the charts of YouTube taking time spent from Netflix and them basically taking market share, and Netflix is decreasing within streaming time spent. I think that's something investors in Netflix need to worry about. I'm sure they're tracking this, but it would be a big concern for me if that continues. eh, where's your pricing power?
Yeah. I mean, they have done a phenomenal job over the years. Every like big crossroads they've come to, they've done a pretty dang good job like moving to sort of a new medium. Not medium, but evolving the platform. So you said it, advertising for the longest time, they were ardently against it. And they rolled it out in a really successful way And they've also done it in a way where as long as they have good content, I think you have pricing power on the ad-free plan because people will want to get away from ads. And then on the flip side, the password sharing crackdown seems to have been a success. I remember a lot of people being very worried about that. It made all the sense in the world, and now you see a whole lot of other platforms following suit.
There's a lot of takes on Netflix. People have either very bullish or very bearish takes a lot. I remember when they entered gaming and people thought that that was going to disrupt Xbox and PlayStation, and it hasn't. But that doesn't mean that, they probably had they probably lost money on that initiative, but hey, it's fun to test out. Maybe it has a future for them.
Yeah. We got some question here. Thoughts on the Warner Brothers Discovery buyout to create a scaled competitor with Netflix? Would that
Nope.
degrade Netflix's pricing power or just create a rational duopoly? I think people subscribe to Netflix for the ongoing content, not the old catalog for the most part. Like, I hold my Netflix subscription not because they have a whole bunch of old content that I got to get to, but because they constantly release things that I want to watch.
I've never had good thoughts here. I only have it now because T-Mobile gives it for free. I wouldn't have it. Um, I don't
It's
know.
the one I've
I
just
think
never
look,
gotten rid of.
the duopoly is YouTube and Netflix, not Warner Brothers.
Yeah. No, yeah, I
It's a new
agree.
world.
I would much rather like, if you were betting on one of the platforms independently, I think I would feel more comfortable owning YouTube. I think the upside for that business is higher, but obviously you can't buy them independently. It still remains a phenomenal business. I just think it's very, I think it's closer to maturity than people maybe give it credit for.
Maybe, maybe, but we Netflix has been doubted time and time again. I'm so scared of doubting them because of their track record. It's like doubting Amazon. They just keep chugging along, and finding new growth opportunities. All right, let's get to your which you put into a lot of research here. It's 6 hidden suppliers powering the AI boom. Why did you want to do this? What are the criteria? And then just get into your list.
Well, the reason I wanted to do this was because I hear so much talk. We talk about it seemingly every single week on this Power Hour, where we talk about the boom in AI infrastructure spending, and you see it every single quarter. Mark Zuckerberg says we're gonna, build data centers the size of Manhattan. You're seeing it in the capex spend from hyperscalers, and it's all going towards these massive data centers.
And we're recording before these companies have conference calls this afternoon. We had some listeners here say that they wanted us to predict whether capex is going to grow or decline. Maybe that'll be a good tease to talk about these 6 companies. This is almost a coin flip, I would say. But Ryan, what do you think? The aggregate capex guide, is it going to go up in 26? Are they going to guide for up in 2025? Just in general, do you think it's going up compared to 2025? Excluding Oracle,
Um,
because they're crazy.
Sorry, do I think capex will be higher in 2026 than
For the
2025?
big 4, Microsoft, Meta, Amazon, Alphabet,
Yes, I
comma.
think it will be higher, but I don't know what the tone will be and if they raise guidance
Don't
from their already raised guidance. So,
the second derivative is gonna slow down there, yeah, so we don't know, we can't predict what the stock is gonna react on, but I'd agree, I think it's almost certain given what they're saying that CapEx is gonna be higher. I mean, look at that Microsoft OpenAI deal, $250 billion. That's
yeah.
that's quite sizable.
Yeah, and so, I guess the goal here was this is sort of the modern gold rush, and there will be beneficiaries. We're already seeing it, obviously. There will be beneficiaries that are not the hyperscalers. There will be to use the picks and shovels analogy, and for anyone that's unfamiliar, sometimes I think we spit out that analogy and people don't know what it means. In the During the sort of California gold rush, people moving out west to go strike gold, find gold. There were a whole bunch of prospectors that went out there, wanted to get rich. A lot of them did not get rich, but the companies or the merchants that made the most money were the people selling the critical supplies for all the people going out to find gold. That was the quote unquote picks and shovels providers. So who are the picks and shovels providers for data center spending? I found 6. There's probably more. I might have missed some. Before we get into these, I'll say the cat's kind of out of the bag on a lot of these. It's shown up in the results. It's shown up in guidance. The stocks have all done very well for each of these, but I'm going to go through them. The first one for me is Amphenol. We've talked about them before. For one of the largest manufacturing businesses in the world, I think a surprising amount of people don't pay attention to them. They make like point-to-point cables, power distributors, sensors. It is sort of a boring business, but they are reporting pretty much their highest revenue growth in 2 decades right now, despite being like substantially bigger than they were in the past. 53% revenue growth. This is one of the largest manufacturing businesses in the world because data centers are turning to them during these build outs. They need Amphenol. And yeah, it's just seen a massive acceleration. So Amphenol is one of the critical suppliers. The second one here, this might be the one I'm most attracted to. And I talked to John Rotanti about this. He said this company is the first call. As soon as a hyperscaler or whatever decides we're going to make a new data center, they call Quanta Services. It's one of the first companies they call. So they are one of the largest designers and installers of electric transmission and distribution lines. So basically, there's been a big strain on the electric grid from this. We've seen all the commentary about how energy prices are going up for people because data centers are consuming so much power. And in order to get power to these data centers, they need Quanta. So they will literally call Quanta, plan it out, map it out, see if it's feasible to have a data center in certain locations, see what it's going to require. Here's a quote from Quanta's CEO. He says, if we're going to lead the country and the world, you have to have power, and we are right in the middle of the infrastructure. Brett, maybe you can pull up some of the charts from these companies because you're going to see pretty much every single one, you're going to see an acceleration in revenue over the last 12 months.
Okay. I was going to ask revenue. All right.
I think Quanta has like an absurd backlog figure too, if I'm not mistaken. But yeah, anyway, Quanta is transmission lines. Amphenol is cables and sensors. And then the third one here, admittedly, I don't know. I'm going to use some terms here that I don't know if I know very well, but it's Arista Networks. They make high-speed switches and routers, as well as specialized operating software that connects servers and storage system within data centers. So people call them apparently the toll booth of AI, since basically like so much data is moving that it has to be fast, it has to be reliable, and it needs to have super low latency. None of that would be possible if it weren't for Arista Networks. Yeah, you're showing what do you got there?
It's
Quanta.
Quanta. It's
Now,
Quanta.
yeah,
I'm moving on for you to Arista next.
it's and I think the insider ownership on Arista Networks is incredible. Let's see if I can pull this up. I think this is the one where the founder still owns like 90% of the company. Let me double check this. I know this doesn't make for great audio. No, okay, I got this wrong. I think I was thinking of a different
It's
company. But
someone else.
there's
Hey, look at this 2012 to 2025 estimate, but I mean we're almost there. Revenue has gone from 193 million to close to 9 billion and grown at a 34% annual growth rate. It's quite impressive.
yeah. And it seems like every one of the companies on this list has had a pretty good go of it lately. But yeah, Arista, it's been a decade of just higher and higher demand for their switches and routers and operating system. The last three here, this one is Veritiv Holdings. They are basically powering and cooling solutions. So with the data centers, the one thing you see pop up time and time again is that there's a whole bunch of cooling providers. So Veritiv's not the only one, but because GPUs require a lot of power, they generate a lot of heat. That heat needs cooling solutions, and Veritiv is one of the leading providers. I think they have like a, let's see if I can find it, liquid cooling, some sort of liquid cooling technology that has been in high demand as of late. Also, fairly recent to public markets, if I'm not mistaken, which is kind of surprising given how big the business is already. But there's been a couple things with all of these businesses. They have not only have they seen massive demand, but they've also seen significant operating leverage because there is so much demand that they're raising prices for to provide their services. And it's just been, I'm sure that there's going to be a pullback at some point on spending from these providers. And I imagine with most of these companies, there's a lot of upfront revenue. There's probably some maintenance revenue as well, because you obviously have to maintain the systems, the transmission lines, whatever, if you're any of these companies. But there is probably a lot recognized upfront.
I'm gonna be honest, I'd be so scared to buy any of these. So scared.
Yeah.
Its revenue could be down 90% if people are right that it's like the telecom bubble.
Yeah. I mean, these data centers have to be maintained. So if you have a big services component to your business, like I think Quanta Services specifically has a huge portion of their revenue that is
Higher
not product
percentage?
revenue.
Okay.
I think they're going to be in a good position. And a lot of these businesses,
What if they mothball the data centers?
what do you mean?
Like they're like they don't get used. They shut them down.
I think at some point someone's going to come along and pick them up.
I
I
hope.
would be, I mean, I don't think it's going to be as bad as telecom. Like that was what, 15 years of overbuilding. I just, I have doubts that it's 15 years overbuilt already,
Wow, we're
especially
not
not
maybe not
yet.
there yet. Maybe by the end of next year, if we have the trillions in dollars spent. You mentioned Vertiv. I think they were actually a SPAC because the price was at $10 for a long time. If we look at their stock chart, it looks like they went public during the SPAC boom. $10 SPAC merger price, and they're at 200 today. So it's been I know the math is not exact there, but about a 20 bagger in 5 years. Pretty darn good.
Yeah. All right. Last two here. This one, very well known, Micron. So here's what I understand: GPUs also require a memory system and they require memory chips. Apparently, they require 5 to 6 times more DRAM, which is moving memory. They require 5 to 6 times more DRAM capacity than traditional servers. So Micron, one of the largest DRAM chip providers in the world, them and SK Hynix, I think, are the two biggest, maybe Samsung as well. They have seen a huge surge in DRAM demand. So here's a quick quote from their CEO. It says, "Our HBM performance has been strong and robust demand, tight DRAM supply, and disciplined execution have significantly strengthened the profitability of the rest of our DRAM portfolio." This is one,
For for people that don't know, is dynamic random access memory, so dynamic RAM. I wanted to look that up. It's
yeah,
essentially for part of the we're not experts on this, but it's similar to the RAM on your own computer, but they're selling it into data centers.
yeah. From what there's NAND and DRAM. One of them is considered
True.
moving memory, and
Yeah.
DRAM is considered sort of the memory chips needed for GPUs. This is probably the one I'd be the most concerned about because if GPU demand declines, they are basically a byproduct or they are a layer on top of that, which would also mean demand declines for Micron, unless I am totally off on that. But they've seen a huge surge in moving memory chips because of the growth of data centers and the need for GPUs.
They've
The
historically been a very cyclical stock. A lot of drawdowns, a lot of tough periods, but they're one of the only players left.
Yeah. Last one here. This one actually interests me as well. Comfort Systems provides mechanical, electrical, and plumbing contracting services. In other words, they are the company that makes the industrial buildings actually livable. So
More of a
this I like.
construction company. Yeah.
Yes, I assume there's some like services element to it, but if you can, if you're the plumbers of data centers, but yeah, basically they are sort of a construction provider. And then the big 3 hyperscalers are their 3 largest companies by far. They have
They're another 20 bagger over 5 years, 88% total return CAGR over the last 5 years. Not bad if you could find Comfort Systems 5 years ago.
it's so here's the issue is I don't feel really comfortable owning any of these given how much of a jump there's been in demand. But and this doesn't matter now. But we talked about this on our show yesterday, the AMA, and that's going to come out later. These businesses will be better off, most likely, unless they're investing into it and they ruin them, sort of create their own demise. These businesses will be better off 20 years from now because of the AI boom. They're going to have a whole bunch of cash. They're able to reinvest it. It's to me, that's like the Amazons of, well, maybe not the Amazon, but whoever the picks and shovels providers were during the dot-com era. There is for sure, well, maybe not for sure. It's likely that there will be a slowdown in demand, but that doesn't kill them. Like if the AI boom never happened, I think they would be in a worse position than having all this demand come through. Do any of these excite you?
I might just say being more nervous about that. I think Cisco either is barely or below its dot-com price, which is the company you were describing. And I would remember when we studied Peter Lynch, and he said if a company starts accelerating its revenue growth and growing at extreme rates, it can be difficult because you need to have a management team that can deal with this. And it can be quite hard for a business that's growing quickly. You can get less efficient. You can stop worrying about things. And we've seen this with Silicon Valley companies all the time. I'd much rather have a business. What's Munger's quote? I just hate to be the quote guy, but Munger said, "I want to own a business that never gets overvalued, just steady Eddie growth, consistency over and over and over." There could be major downsides to this. What if they lever up? What if they have just insane inefficiencies? What if they again do 15 years of demand in 5 and then you have nothing to do for 10 years? Do you fire everyone that you hired? Do you because you have twice the employees now? I mean, what
These
happens? I think this
but these
is
guys
puts you
had
in a
businesses. They had businesses prior to the data center explosion. You look at Arista Networks. It's not like this is a business that just emerged from the data center boom. Like
I know, but what are you gonna fire? 70% of your employees?
probably not.
Okay, then you're gonna be extremely unprofitable if the bottom falls out.
I think I think there's more recurring revenue to some of these businesses than, well, maybe not all of them, but like Quanta, Arista Networks, I think they both break out a services line that's meaningful to the business. Let's look at Arista Networks. If they have a large services component, never
Yeah,
mind.
that's definitely something to look at is like, all right, what of this is recurring and what of this is one-time spend? Like, if you look at the companies such as Super Microcomputer, you
Yeah.
go, okay, well, they're just that's a tough one. That's they might be the quintessential one that I'm kind of describing here. If the bottom falls out, they could be in real trouble.
Yeah, I'm not seeing how much is from services for Quanta, unfortunately. But we'll see if I can. I mean, services is in the name, so I've heard it's largely services businesses, largely services business. But yeah, I do think you're right. The demand is likely to fall here, and they are pricing it. It seems like the investment community is pricing in all of the commentary from the hyperscalers that we're going to be building $7 trillion or whatever that estimates are for the next up to 2030. And if that happens, yeah, there's going to be plenty of cash flow for these businesses.
Okay, let's talk Visa, Ryan. You ready for some macro talk?
Sure.
All right. So they reported yesterday, and I like looking at them just in reality for consumer spending, a little bit for business spending. But if you look at North America and global, just consumer spending, they are going to be, since they do over $15 trillion in payment volume, they can be a fantastic indicator with the government shutdown and the loss of some of the statistic stuff for inflation. Have you seen this, Ryan? That like 35% of inflation inputs now are just pure estimates. That's another rabbit hole that we don't have time to go down on investing power, but looking at Visa might be a better indicator of consumer spending and consumer health, and then combine that with banks, and you can kind of get a good look at things. So let's go through the numbers. Net revenue up 12% year over year. Payments volume grew 9% year over year. For reference, Amex grew 8%. So about the same. Probably depends on what decimal you're using. I'm sure it's fairly similar. Total cards grew 6% to 4.9 billion. Now, some people have multiple cards. So again, that's not 4.9 billion people. For the full year, which this is the end of their fiscal year, 50% net income margin, $18 billion spent on repurchases this year, 2.6% of the current market cap. Is this one? A lot of people are asking about the thoughts on consumer health in relation to these layoffs. And two, is this the perfect stock to buy when inevitably, not saying it's going to happen tomorrow, but at some point the market crashes?
Yeah, maybe just because it's inflation protected and it's very profitable, but I still don't love the valuation on Visa. If unless I haven't checked it in a while, so I'm checking it right now. Let's see, EV to EBIT, I think is a fair multiple for them.
Yeah, or PE.
28 times. You're probably getting 10% EPS growth, would be my guess.
That's what they were about growing. Yeah, I think they had some one-time stuff, but yeah, today, look, not buying,
Visa
especially.
just bores me. It just bores me.
Yeah,
Great,
but
yeah, macro indicator, sure, yes, yes, and it's a good business, but I just
what's
like
boring about one of the best competitive advantages ever?
the size of it. I mean,
Well, if
like
you can
payment
get them
volume,
at
unless they
the
have a
reason why I put the repurchase number in there is if you can get them at a cheap enough price, it can be similar to the Amex in 2023, where you have such a good buyback yield that even if growth isn't as impressive because of their size, hey, that can be a phenomenal return. Never sell stock for your portfolio.
yeah, I mean, I think it has been for pretty much everyone. It has, if I'm not mistaken, actually underperformed the market. I'm gonna double check this right now.
From maybe 5 years could be true.
Yeah. Total return last 5 years, S&P 500, which granted, the S&P 500 has had a very good 5 years, is up 123%. Visa is up 93%. My thing is like, why would I own Visa instead of American Express? I like American Express better.
Yeah, I agree. I agree. I mean, both aren't too cheap today. At similar valuations, I'd maybe lean Visa just because they've been the better grower and they're more efficient. But look, they're not at the same price. Amex is cheaper. The gap is narrowed. I think both of them are one that if the price gets down to a reasonable multiple, let's say 10 to 15 times for Amex, maybe 15 to 20 for Visa, those are ones I would just buy without thinking in a recession.
See, that's my issue. Is okay, yes, all stocks are down, whatever. Like, let's say all stocks drop 50%. I would love to buy Visa at, I would feel very, very comfortable, and it would be an easy decision to buy Visa in a massive drawdown. My thing is that, like, it's buying Visa for me is like admitting defeat on active investing. It's like,
No, what? That's
yes,
not a good way to put it.
Because the cat's out of the bag. This is the
What?
biggest network effect business in the world. Everyone
Mm.
knows it,
I
other than Meta.
well, it's got a better network effect than Meta now, since it's not social media anymore. But I disagree. I disagree. I disagree. It's not giving up on active investing.
It's just
That
so
seems to
boring
be
to
a
me.
bit that seems to be a bit of a stretch. I get where you're coming from, but
How
Ryan,
many
you own
people just
Alphabet and Amazon.
yes, but I bought like I said, I didn't buy them at 29 times earnings. The if this
Okay,
got cut
so
in if this got cut in half, I would feel comfortable buying it. Yes, very much so. But buying an already obviously good business at a 2.5% buyback yield when treasuries are at 4 or whatever doesn't that's not that attractive to me. And it's
no, but
I
you gotta
I
keep the
think
watch list up. You keep tracking the business.
yes. Yeah, yeah, yeah. No, I'm on board with the business being high quality, but it feels to me like anyone buying here is doing so like on autopilot. Like there's probably a lot of index funds that own this that just buy it blindly because oh, it's a good business, whatever. It's been a good business for 30 years. I'm just going to buy it. I don't care about the price.
I
That's
agree with that. Yeah.
that to me it's like I might as well index.
I mean, I'm not. Yeah, yeah. I'm not thinking of buying whatsoever at these prices. Let's talk about Microsoft and OpenAI. We have to, since Microsoft shot up to on this news. I think Nvidia went through 5 trillion. Microsoft went through $4 trillion. I'll maybe as a quick shout out the two founders of Microsoft and Nvidia, the two largest companies in the world. Do you know what schools they went to, Ryan? At least one of the co-founders of Microsoft. One, our alma mater, Washington State. And do you know where Jensen Huang graduated from on undergrad? Oregon State University. Shout out
No
the
way.
Pac-12, huh? Yeah,
Good
10
for
trillion,
Oregon
almost
State.
$10 trillion in market value from the good old Pacific Northwest. But let's talk about Microsoft and OpenAI. OpenAI officially spun out its for-profit arm where it has this. I was confused at first why they're doing this, but I guess they want to funnel money, some money from the business to a nonprofit, which I guess is fine if you just have a separate stock. They just have a ownership stake in the for-profit corporation. So its nonprofit holds an equity stake worth $130 billion, and that is a 26% stake in the company. It's worth $500 billion. 47% is held by current, former employees and other investors. So those employees are worth quite a bit of money. Microsoft holds a stake valued at $135 billion. Good on Microsoft. I mean, it's been probably a 10 bagger for them. Quote, the OpenAI Foundation will make an initial $25 billion commitment to work to accelerate health breakthroughs and technical solutions to AI resilience. AGI now has to be verified by an independent expert panel because that's part of the contract with Microsoft utilizing OpenAI's tools. That's also, again, it depends who's defining AGI. Here's another one that's important. Microsoft has IP rights for both models and products extended through 2032, and IP rights now for the consumer hardware that OpenAI is developing. Lastly, OpenAI has contracted to purchase an incremental $250 billion of Azure services. Where it's going to get this money, I'm not sure, but that's not Microsoft's issue. Would you invest in the OpenAI non-profit, or excuse me, for-profit arm, not the nonprofit?
I would probably
And does
not invest
Microsoft
in the
stock
nonprofit.
deserve this bump? Maybe I can answer first on the Microsoft part. They seem to be crushing it with this deal. It's kind of a win-win situation for them. They look, huge stake, huge Azure commitments, all these IP rights. They're just doing great with this OpenAI relationship.
Yeah, it seems to benefit them in plenty of different directions, and having the I don't know, having the tie up here is just a nice way of basically not having to build this internally, and not having to front the expenses. Like they're kind of being subsidized by venture capital in a way. Like if VCs are pouring money into OpenAI and a lot of that spend just goes to Azure services or a lot of the innovation that OpenAI does on its models benefits Microsoft. They're one of the first customers to benefit type of thing. It's it. it seems like a nice position to be in for Microsoft.
Okay, I have other ones, but I want to finish on this. OpenAI plans to IPO by 2027, and they said that, and I don't know if this is going to make you excited or nervous. They said that with this reformation, they can now finally be aggressive with fundraising. That's what essentially what they were saying. Yeah. So it's going to get worse.
Okay, maybe we can timestamp this. I bet I bet they do not go public by 2027. Markets
Okay.
at some point, it's gonna be like the WeWork situation. Obviously, there's a little more validity to this business model than WeWork, but it was all hyped up. Everyone thought it was gonna be a huge IPO. Markets soured on their losses. I think OpenAI is going to release their S1, and then they're gonna delay their IPO because people
Or
are
not even release this one. Yeah.
yeah.
Okay. Hot take. I'll yeah, timestamp this. Someone if they go public, someone can come back and remind Ryan on this because we'll probably forget about this moment.
Yeah, yeah. The I think whoever is involved in the latest rounds of OpenAI's funding will lose a ton of money. Private funding. It reminds me of or at least it'll be dead water. But remember like Uber had that massive private round before going public at a
Yeah.
huge valuation,
With
and then
SoftBank, yeah.
it was underwater for like 5 years. Maybe that's what VCs expect, but in a late round investment, but it's I don't know. It feels like this is bound to flop. There's so much hype right now, and as soon as that S1 comes out, I think people are gonna see whatever $20 billion in revenue, and then you're like, "Wait, 20" and keep in mind, the forward guidance for this year, I think, was 13 billion in revenue for OpenAI. Let's say they're at 20 billion next year, maybe more. The valuations on these things are already absurd if that's the sales in whatever, however,
Yeah,
like
they had
2026,
$500 billion
2027.
market value. Look, the initial investors, the initial outside investors, they've been diluted down to like 1% or less, which is still billions of dollars, but it reminded me of the social network situation. Hey, we got some new investors coming on there, Microsoft and SoftBank. We need a lot more money, and they're gonna
Yeah, I mean, they're winning
you're gonna get diluted
anyways.
away.
They've got
Capital intensive business, I guess that's what happens.
I'm sure they have pro rata what like a lot of these I think most funding rounds, you get like pro rata rights or whatever, so you can invest in all the following ones to like top off your current stake.
These funds
But
probably just didn't have the money. They just
yeah,
Microsoft, they needed $10 billion, so
exactly. But when you're raising 10 billion, it's like, oh, okay, topping off our stake is not an option here. But at the same time, your stake is smaller of a much larger pie.
yep. Alright, we have dealer's choice, Ryan. DoorDash short report or Amazon and UPS layoffs? What do you wanna talk about?
Well, I was going to say PayPal and OpenAI's partnership, but I'm tired of talking about OpenAI. So let's do Amazon and UPS layoffs.
Alright, so these happened both this week. I don't feel like a bit of a coincidence that it's two of the biggest delivery companies for consumer spending. That would maybe make me nervous about retail spending, although do we invest on this type of stuff? No, we're long-term investors. We have a multi-year time horizon. Amazon is laying off 30,000 people in corporate. According to my sources, aka friends at the company, they already laid out half this week. And despite this, they're hiring a ton for this might not be music to your ears, Ryan, in things like Kuiper and other places that are their big tech research places. They're accelerating hiring for the science projects, which may or may not work out. UPS is laying off 14,000 in corporate and 34,000 operational roles. On top of this, I guess is much smaller. Target is taking out 1,800 corporate roles. Is this news or noise with consumer spending? Obviously, you don't celebrate layoffs, but thinking objectively from an investment perspective, any thoughts here?
Yeah, I really don't know what to think because on the one hand, this could be. I remember when Amazon announced their layoffs in 2022, everyone was like, this is a sign demand is screwed. And it ended up just being like a
The
contraction of the
recession is here.
workforce that was
Yeah.
needed. Yeah. I could see this being more of the same, but at the same time, it feels weird to lay off 30,000 corporate employees right before the supposed busiest time of the year for Amazon. So I don't know. It makes me feel like this is sort of a bad indicator, but I'm not against Amazon prioritizing their research projects, quote unquote. I actually think Kuiper could be a promising business for them. It's going to be super capital intensive, but if they are able to, if they're able to emulate or copy SpaceX and Starlink,
Got to get it out there though. They just seem to be slow versus
they had their
Starlink.
first couple launches, right? Or first
Yeah.
launch, if I'm not
Eh,
mistaken. But it's yeah,
we'll
yeah.
see.
It's
We'll see. It does have potential for sure.
yeah, and those ones it's also beneficial to their own business, like having whatever internet connection in remote areas for deliveries or what. I'm sure there's ways that it can benefit themselves beyond actually offering it to customers. The but I would be worried. Like I guess not worried, but I think this is a bad sign for the e-commerce side going into Q4, going into the Christmas season to lay off 30,000 people. Maybe
UPS 30,000 operational people, which is non-corporate. Yeah.
yeah, and it's not like I saw some people saying it's like, no, they're just being replaced by the robots. Like it's all automation. This is corporate. This is not warehouse employees. And these are supplemental roles to like a lot of those corporate employees are probably tied, I imagine, to the e-commerce business, whether it's management, managing teams at those warehouses, whatever it is. I assume a lot of them are tied to the e-commerce side. So yeah, I guess call me a little bit worried. Yeah.
I'll say, yeah. What should I say? Not cautiously optimistic, cautiously pessimistic. I think I'll lean that. If we're gonna go corporate speak, slight nervous on this one. We'll see what the numbers play out as, but we'll. I don't know. Maybe this just means Amazon's profit margins are gonna keep expanding, but the timing on this feels suspect.
Did they say whether or not this was specific to a certain uh,
No, it was
business?
widespread, and they said that they still too have too many middle managers.
I'm okay with that. And from what I've
If
heard,
they
they
overhired,
do.
yeah, they
I've
probably do.
heard that there's a few too many people just managing people.
And that's a great way to end the episode. All right, Ryan, anything before we get out of here? I guess we went a few minutes long.
No, I think that's gonna do it. We didn't get to Philip Morris earnings. Maybe we can go back and talk about that in a week or two. But hopefully people enjoyed the episode. Good luck to everyone this earnings season. May the odds be in your favor.
Yeah. Yeah, all right, that's a good way to end it. As a disclosure, we are not financial advisors. Anything we say on this show is not formal advice or recommendation. Ryan and I or any podcast guests may hold securities discussed in this podcast, may have held them in the past, may buy, sell, or hold them in the future. Thank you everyone for tuning in. We typically do these live on Thursdays at 5 p.m. Eastern Time. Next week, we are not doing anything live. We have pre recorded the Ask Us Anything episode that will be coming out Friday morning. So look out for that on the YouTube page, Spotify, or Apple Podcast, or wherever you get your podcast. Thank you, everyone, for tuning in once again, and we'll see you next time.